let's proceed on from where we stopped last time when we were doing the capital asset pricing model. Now, before we go to the past papers, I want us to get to understand a sub-item in Capm, that is application of Capm in determination of efficient inefficient and super efficient markets. Then you write below that Capm is used to classify portfolios. Capm is used to classify portfolios as either super efficient, inefficient, or efficient or super efficient. I'll say it again, as either super efficient, inefficient, or efficient. I.e., that is, the model provides a framework upon which to classify portfolios, as either efficient, inefficient, or super efficient. As either efficient, inefficient, or super efficient. Then a paragraph below that. Portfolios whose expected return is more than the required return, are said to be super efficient portfolios. Is more than the required return, are said to be super efficient portfolios. A paragraph below that. Portfolios whose expected returns are less than the required rate of return, are known as inefficient portfolios. Then a paragraph below that. A portfolio whose expected return is equal to the required return. A portfolio whose expected return is equal to the required return is an efficient portfolio. Is known as an efficient portfolio. Full stop. Just with regard to that, let's get to the past papers. May 2021, question number 2C. May 2021, question 2C. May 2021, question 2C. May 2021, question 2C. The question reads, Zachary Mosomi, an investor, holds the following portfolio of 4 risky assets and a deposit in a risk-free asset. he has provided the following information. You've been given the assets which form the portfolio, the weighting factor, the current return, the beta factor, and the risk-free assets, and the expected return and expected beta. The overall return of the market portfolio of risky assets is 11%. You are required to get the portfolio return and beta. Then, using the results obtained above, deduce the type of investor, securities. Then, using suitable computations, determine the assets that are inefficient, efficient, or super efficient. Then, you calculate the equilibrium return of the portfolio. Now, let's start with the portfolio return. Roman 1, portfolio return. Portfolio return. Portfolio return, you take the weight of A, which is 20%, 0.2, times return of A, which is 12, plus 0.1, which is the weight of B, times return, which is 18, plus C, which is 0.15 or 15%, times return, which is 14, plus D, which is 25, or which is 0.25, times return of D, which is 8. Once we do that, we'll come up with the expected value of the return to be. You work it out. 0.2 times 12 plus 0.1 times 18 plus 0.15 times 14 plus 0.25 times 8. I'm getting 8.3%. Expected return of the portfolio is 8.3, while the expected beta of the portfolio beta will be 0.2 times the beta of A, which is 1.5, plus 0.1 times 2, 0.1 times beta, which is 2, plus 0.15 times 1.2, plus 0.25 times 0.9 times 0.9, yes. Once we work it out, 0.2 times 1.5 plus 0.1 times 2 plus 0.15 times 1.2 plus 0.2 times 0.9. I'm getting 0.86. Roman 2 of the question. Using the results obtained above, deduce the type of investor Zachary is. Deduce the type of investor Zachary is. Then you write below that, Zachary is a risk-averse investor. Zachary is a risk-averse investor since his portfolio return is lower than the market rate of return, is lower than the market portfolio return. In addition, his portfolio beta is slightly less than 1. his portfolio beta is slightly less than 1, and this implies that he is a risk-averse investor. And this implies that he is a risk-averse investor. Then from there, you've been told, using suitable computations, determine the assets that are inefficient, efficient, or super efficient. Therefore, you write below that, let's determine the assets which are efficient, inefficient, or super efficient. Therefore, you write, we have assets A, B, C, D. We have, from there, we have the expected return. We have the expected return. We are going to use Capm, the security market line equation. Therefore, for A, we know that is RF plus beta into brackets RM minus risk-free rate. So the risk-free rate for A, we know the risk-free rate is 5%. So 5 plus beta of A is 1.5. All that times market return is 11 minus 5. This gives me, that is 1.5 times 4 plus 5. It gives me 11. Then from there, I will have 5 plus 2.0 into brackets 11 minus 5. This gives me 6 times, this gives me, let me repeat this one. It should be 11.5 is 6. 11 minus 5 is 6 times 1.5, that's 9, plus 5. Sorry, it's supposed to be 14%. The other one will be 6 times 2, it's 12, plus 5, 17%. Then for C, it will be 5 plus, the beta for C is 1.2 into brackets 11 minus 5. So it's 6 times 1.2 plus 5. This is 12.2. Then for D, it is 5 plus, the beta for D is 0.9, 11 minus 5. This gives me 0.9 times 6 plus 5. This gives me 10.4%. This gives me 10.4%. Then from there, we know the current return. We have the current return. This was the required rate of return. It is the required rate of return. Now, expected return has been given. Expected current returns should be 12%, 18%, 14%, and 8%. Therefore, according to the definition of super efficient, inefficient, and efficient portfolios, we say a portfolio is said to be super efficient if the required rate of return, if its expected rate of return is higher than the required rate of return. In this case, it is less, and therefore it is inefficient. And therefore this one is inefficient. again, the expected is higher. This is super efficient. Then in the other one, the expected is 14%, which is higher than 12.2. Again, it is super efficient. Then the other one, 8 is less, therefore it is inefficient. And therefore, basically, that is how you measure whether the performance of a portfolio is super efficient, inefficient, or efficient. And therefore, that's the solution to that question. And we are going to meet in our next session so that we can proceed on with something else. Have a nice time. Thank you.